Awesome! So now we're talking about Facebook, which is super exciting. These guys have been performing really well, and there's a lot of really core foundational principles to learn from how their price is moving in the past couple of years, especially related to one thing that I don't think people focus on enough, but it's like really critical, and it's news, right? And news is important, but it's not just like, an article. Articles come out all the time, right? And that's pretty basic. But what's more important is something where you have public confidence. And a lot of times, like, that confidence comes from a brand. That confidence comes from a persona. And when you have sort of a person as the face of a company, that's really important, because that personal brand represents almost everything the company stands for. I remember very recently, when Tesla was like exploding, and people were making, literally 6, 7, 8 figures off of them with very minimal investments, like 100x returns, 1000x returns on the calls. I mean, just like insane. There were so many like meme pictures all over the place, and it was like, I remember this one picture, and I'll probably flash it up, but basically it was like one of those old pictures from like really ancient religious, I think it's like Christianity or Catholicism or something. And it was like this picture of Jesus like handing over like bread and water to like these starving people. And then instead of bread and water, it was like clip art of like piles of money. And instead of Jesus, it was Elon Musk's face. And like a lot of people say that it's funny stuff, and it was pretty freaking funny. But the bigger picture here is think about how like personality interweaves with investments. Trump obviously doesn't have any like public investment companies that you can like get into. But he did, like, he'd be the face of those companies, he'd be the face of the brand. And you see the same thing with Virgin Airlines, or all the other, like, Virgin companies, like the dozens of companies that Richard Branson has. Like, any effect on the actual person himself that is, like, in front of the company, like if Richard Branson gets into trouble or something, you're gonna see his stocks go down, even though it literally makes almost no difference whatsoever, because he doesn't actually work in a majority of his companies for any, like, reasonable amount of time. Similarly, like whether or not Elon Musk sleeps on the factory floors in a Tesla factory is not going to be the game changer between like 10,000 cars produced and 50,000 cars produced. But it's going to look really good for PR, and it's going to make the stock go up for no reason other than public perception. And that's kind of one of the big takeaways that came here with Facebook stock. So we got in this position at what, 165? I think it was right 165. Yeah, right here, right with this candle right here with the big wick. And I got in pretty simple, long-term investment. Facebook is a pretty freaking solid company. Their PE is about 32. Like, they make money, and I know they make money because I pay them a lot of money, and I know a lot of people that pay them a lot of money for ads, and so like Facebook, like they make money. It's like not a question. Like, they are huge. They're a $600 billion company. And what's cool is if you scroll down just a little bit in Yahoo Finance, you can actually see this little chart right here. That'll show you sort of the growth. So they're making like billions of dollars, and they're earning billions of dollars. So like they make a lot of money. It's like not something to question. Like they just have been doing, like they just do really well because like basically their advertising platform prints money for them. As long as they have like visitors, like they're good. So yeah, so like basically that's like fundamentals. Like fundamentals, they make money. It's not that tough. And so we got in a couple of other things that were really critical here. Is if you look at stochastics, you have this balance off of the 20 stochastic level, and you have a cross of this red line and the black line. So the black line across the red line, that's really great, like bullish indicator right there. Similarly with the MACD, you've got this blue line and this orange line, and you're very close to a cross, and within like a week they had a cross. Very bullish, super cool stuff. So in the short term, like the short-term price like looked really great, and so because of that, I wanted to get in the short term so I could hold it for the long term, right? This isn't a position I was going to manage very much because like Facebook's really well established and they make a lot of money. So like when you have a $600 billion company, usually it's not going to swing trade very well. It's usually just going to be like a solid long-term investment most of the time. Obviously, exceptions, Tesla exceptions, Virgin Galactic, stuff like that is crazy volatile, and so you just have to obviously like look at the chart, and you can usually tell by looking at the chart. So this is a chart for like what, 4, 5, 6 years, and you can zoom out too, and you can look at the exact same chart, and basically like they went from $50 to $200 over the course of a decade, which is like pretty great, but it's not like super volatile. There's no like big spikes up or big spikes down. Like it's a pretty consistent chart. And so because of that, like you kind of know, I mean, the most volatile time they ever had was back here when the Bollinger Bandwidth peaked a bunch. And that was when they went from give or take $40 to give or take $50. So like the most volatile time period they had on the upside was like 20%, which like isn't really, that much. To go from 25 to 35 is not like that big of a stretch for a lot of companies. But it's still pretty solid, so it's something to respect. But really what you're looking at here is not so much the volatility gain. Until, of course, this crap happens, right? So what actually went down here is pretty interesting. So basically what happened is I bought the stock and then it went up a bunch, which was sweet. And then had this really nice green, red, green, and another green, red, green, and another green, red, green. Had like 3 green, red, green candlestick setups in a row, which is like unheard of, like really, really great. That's phenomenal. And then something happened. Basically, you guys probably remember this, like there was Congress, right? And Congress was like freaked out about like how Facebook uses data and how all these big companies use data. And oh my god, all the big companies are using all of our data. They're selling all of our data. It's the worst thing ever. And I'm like, dude, like of course they're selling your data. How do you think they advertise to you effectively? Like how do you think you target people on Facebook ads? Like you have to know like who they are so you can target them. It's not like a difficult thing. Anyway. There is just like so much crap about people like saying that like Facebook owes them money. You have to understand that like, people like Facebook, people like Google, people that have like these big data. And I'm not gonna go too deep into this just because it's like weird political stuff, but I see it so often. And I know like Yang right now is like proposing to give everybody free money. And it's like, oh, we're gonna get it from the big tech companies. Like they had to risk literally like everything they had. Like Zuckerberg risked like everything. He risked money that wasn't even his to start his company. Same thing with the guys at Google. They risked money that weren't even theirs. Like they were literally risking everything to go all in on their company. And now, and only now, that they have gone from a stage of like having zero money to having a ton of money, now that they have a ton of money, they should be required to give all this money back to all these people for doing literally nothing. Because they put in all the effort, all the risk, all the work, and literally thousands of hours of time to actually create, for example, Facebook. They put in all this stuff to create an actual business asset, to creating like Wall Street company that's worth billions of dollars. And now, like, because they're using your data, which you give them, like, you should like get paid for that. Like, so I don't know. That's kind of more of a current thing. So I guess we'll see how it works out. But anyway, so like Congress like basically said, hey, we want to see Zuckerberg in Congress. And the moment you have like any CEO going to Congress, basically the stock's gonna crash. It's not like a difficult calculation to make. So basically Zuckerberg takes it like a man and he walks into Congress and he's got like to go through all these hearings and all these sessions. And it goes on over and over and over and over again. And I think it went on until, give or take, like middle of October, end of October, ask all these questions about like, how are you using our data? Well, we're selling your data so that we can like advertise to you. Like, we're not like selling it, but like we're storing it so that we can like use it to target people. And then they're like, what about this scandal? And they're like, oh my gosh, we're so sorry about that scandal. We didn't want to get scandaled, And it's like these dumb questions. I remember I was watching these live because I own the stock, and it was very interesting and very entertaining. And you also learn a lot about like how the economy works. You learn a lot about how the political system works. You learn a lot about how Congress works. You learn a lot about how government works. And I remember that you've got like 50 of these senators or congressmen or whatever, talking on this one day for like this 4-hour session. And like 3 hours into this session, like he's standing on the stand, he's like sitting there. I don't think he was sitting, he was like forced to stand up for like 12 hours for like a week, or something like that. It was crazy. And he's like getting grilled. This one guy comes up, and this guy is probably, I don't know, I think he was 80. I don't remember what state he was from. He comes up, and he kind of sits down on the chair. He says, how does Facebook make money? And this is Zuckerberg, he looks like straight in the eyes, and he's like, we sell ads, Senator. And it like shows level of complete stupidity and just like such a huge waste of like actual valuable resources for a company that their CEO ought to get asked about like how they make money. Like, it was crazy. And so you have some people that are asking like questions that like make sense, like, what are you gonna do about this scandal? And basically he says, I'll have my team follow up with you because you only have like 45 seconds to ask me a question and I can't really answer that in 45 seconds. And basically you get nothing out of this but like PR, right? And it's not great PR. And so like most of the time, PR, like any kind of PR is great. There's a slight difference with markets though, especially with stocks. Like, you know, you've heard this over and over again. Like, bad PR is good PR. And that's true, but it's only true in the long run. So in the short term, bad PR, like having a congressional hearing or having big national debate about privacy, like, even though it's gonna create a bunch of buzz around Facebook and eventually add more users to Facebook, in the short term, you're basically guaranteed to have a stock decline. It's like, that's kind of how it works with the face of the company being drilled by Congress. And so that's what happened here, is that got it and then it crashed super hard when they announced that they were gonna have these lawsuit thingies. They weren't really lawsuits, they were just like question and answer sessions. And then they went down a whole bunch, and I probably should have bought the 200 moving average, but I didn't because I was silly and I probably wasn't focusing on the stock enough. If I did buy the 200 moving average, I could have lowered my average cost from here to about here, which would have been really, really, really great. I think, you know, now I'm up on this position maybe like 20 or 30% or something, and it could have been more like 50% if I just added it this low. But I didn't because I didn't know if they were going to bounce or not, and if they didn't bounce, then I didn't really want to be in it anymore. But they did because it was just temporary news, just a temporary pullback. And it was just a little bit of BS at the time that in the long term, you know, who knows what it's going to do. Obviously, it's helped them make better policies for the future. But from an investing standpoint, really the big takeaway here is that sometimes you'll have news, you'll have short-term events that are going to be like bad, and short-term events that are going to make bad PR. And usually it's pretty entertaining to like actually watch them. Like, I would recommend like if you have a big event like that. Like, definitely, I remember I was like in the gym, like listening to these conferences live. I'm like doing some curls, hitting up some bench, and in the background I could just hear Zuckerberg like groaning and dying. He did a good job. He was like trying to you know, sound professional. And just kind of one of those things where maybe it's not something you would expect. Like, you wouldn't expect this to happen. And when you have events that happen that are unexpected and that happen really quickly, what you're usually gonna see is like a stir in the marketplace. And that's kind of shown here by this massive, massive drop in a very short period of time. I remember the stock was down like 13% one day. I'm like, oh crap, there are all my gains. And I'm like, what just happened? That's usually when you have like some crappy news article. So some of the investments you make, you're just gonna have things that are out of your control. And if you, like, basically you've got like two bubbles, right? And they're pretty simple, right? The first bubble are things that you control. This is stuff like technical analysis. This is stuff like doing research, right? Fundamentals, right? Understanding what's going on with the company. These are things that you control. You can spend your time looking for setups. You can spend your time researching a stock. You can spend your time reading an annual report. But then there is this other bubble of things that you don't control. And this is stuff like inverted yield curves. This is stuff like unemployment levels. Some of you guys might know this. Unemployment levels are historically and repetitively at consistent, massive, massive, massive lows right before a recession. In 2007, I remember I saw this news article, and it was from this magazine, this newspaper in Texas. And in this newspaper, they were talking about this company that was going to nearby jails, and it was recruiting inmates who were within half a year of getting out of jail. And they were actually hiring the inmates while they were in jail and paying them a salary while they were in jail to come and work for the company when they got out of jail. Because there were so few people willing to work, and the unemployment level was so low that that they had to go to jails to find new employees. And this comes back to a concept that is gonna sound kind of useless at the beginning, and it might be weird, but it's important that you understand it, because when you get this, all of a sudden, if you combine these two factors, right? If you combine unemployment with inverted yield curves, like, you're literally gonna be unstoppable. These two together are crazy. We talked about inverted yield curves. I think a module ago, 2 modules ago. I got a bunch of videos on it. You can check those out. They're amazing. But unemployment is really interesting. So some of you guys might know this, some of you guys might not know this. Not a big deal. Really, I'm not going to harp too much on it, but there are 3 kinds of unemployment. There's cyclical unemployment, there's frictional unemployment, and there's structural unemployment. And like, I don't want to sound like an economics professor because this literally doesn't matter at all. So I'm going to kind of go through this pretty quick. But basically, frictional unemployment is like, I graduated from college and I'm looking for a job. Or I got fired and I'm looking for a job. Or I quit and I'm looking for a job. Structural unemployment is like, my entire company fired everybody in America because they're hiring a bunch of people in Asia to do our jobs. They're hiring a bunch of people in India to do our jobs, and they're leaving the United States. And then cyclical unemployment is the one that you can't really, well, you can't really control most of these, but this is the big one. This is like the economic cycle. This is like the Great Recession happened and everybody's unemployed. This is like the one that you can kind of measure. These two, like these are gonna sort of happen no matter what. This happens because of business cycles, okay? So basically over time, like you've got, and off the top of my head, I'm gonna do from 2000 to today. And what happens is kind of interesting. If you look at the unemployment level, it goes up. So maybe like we call this like 1999, and it was like super low, and it goes up a bunch and it crashes, and it goes down kind of slowly, and then in 08, it goes up super fast, and it goes down kind of slowly, and I think we all know what's gonna happen next, right? This is like the actual unemployment level, right? But what's interesting is if you take like only the cyclical unemployment level, and you ignore these two, which would just for argument's sake don't matter. You only focus on cyclical unemployment. The cyclical unemployment rate is usually kind of a line that looks like this. And what's interesting is this line kind of goes up a little bit in recession, then it goes down. But when the actual unemployment rate gets below the cyclical unemployment rate by a significant amount, what it means when you have this crossover, right, is that unemployment is unnaturally low. And when there is an unnaturally low amount of unemployment, you have employers that are going to jails to hire people. You have employers that are paying way more. You have employers that are literally like, they can't find jobs because everybody's employed even though they shouldn't be. And so that's how that article comes out from that Texas paper that says you have employees going to jail looking for jobs. And similarly, I swear I could not believe the similarities. But it was, I think it was 4 months ago. I was in a sociology class and the professor pulled up, he pulled up this paper and they pulled up another paper like 4 months later, like 4 months before the 4 months, and it was from like September of this year, and it was the exact same thing. It was about this employer that was going to jail to try to hire people because unemployment was so low. And so those are kind of two really great factors you can look at for like market predictions. Then you can sort of extrapolate those market predictions over to actual stocks, because you know, if you've got a market about to crash and you've got an inverted yield curve and you have super freaking low unemployment, I mean, history repeats itself, right? So that's Facebook. Yeah, so they went down a bunch, and again, you can't really predict the news, and so like things you don't control, right? This is stuff like news. This is, you know, basically it's all news. Like anything I could think of is going to be a subset of news. Like somebody gets fired, the CEO quits, somebody you know, opens up 100,000 checking accounts without telling the clients about it. Stuff like that that you just can't predict. And if you did know about it, it would be like insider trading and you'd probably go to jail. Like stuff like that, you really just cannot care about this at all because you don't have control over it. And if you don't have control over it, like, don't worry about it, don't stress over it, don't think about it, because it doesn't actually matter. If you can't control it, then there's no reason to stress out, there's no reason to freak out. So just kind of ignore things you don't control and just let it come back. Like most stocks will usually come back if there's not like the end of the world happening. And so that's what you see right here is it bounces off the 200 moving average, which is a pretty good entry point. Like if I didn't buy back here, I probably would have bought in here, but I bought obviously a little bit earlier for a longer term play, which didn't work out too well, but I don't know, I even make like 40%, 30%. So went back up, and you know, maybe we'll keep on going back up. I'll probably set a stop loss at like 190. So we'll see. That's kind of more of a market play, right? So, you know, you're not 100% sure on stuff like that just because it's a little bit more dependent on the overall market. And I think we got, you know, some time, a little bit of time, before stuff like that kind of starts kicking in and everyone's freaking out. But I will be spending tons of money on Facebook no matter what the market does, because like you can make like so much money with like online marketing and Facebook, and totally different beast. That really gets into like business assets. which are like literally the best thing ever. I love business assets, they make so much money, they're amazing, but that's a totally different game. So yeah, I don't know, it's a cool part of the portfolio. Would I make this investment again? I don't know. Maybe at the lows. I also really like this really big red candle, green candle reversal. That would have really been the indicator to buy at that low. I think I was paying more attention to Apple at the time just because Apple kind of did the same thing. And they were super low, and then they like doubled. And so I would rather trade a stock that's going to double 50% versus 100%. Like, where do you want to put your effort? Where do you want to put your time and your energy? For me, that's the 100% stock. You can leverage out the options, and then it's like 1,000%, and it's just a lot. It's just a lot easier. So, with that said, if you get a ton of value out of this module, go out there, apply it, absolutely crush it, take the simple trades, and I will see you in the next module. Thanks. Bye.